All right. How's it going, Andrew? Where are you today?
I am in Victoria, British Columbia right now.
Sweet, sweet. All right, people are joining. We'll just give people a minute and we'll kick it off.
All right. Yeah, this was good. I came to surprise my parents. So I was in the south of France, and based on my nomadic life, I wouldn't see my parents for quite a while. Like, we planned to come back here in July for a visit. And then I thought I should come and visit them and just surprise them. So I flew here to Canada, and I called my parents from in front of their house. Then I walked in behind their house, and then I sat in behind just chatting with them for about 15 minutes, and they thought I was in France. And then my mom saw me through the window. It was pretty awesome.
That's awesome. Did she react positively, or was the surprise too intense? Because sometimes that happens where they start. It's a bit too much to handle.
No, I think she just about fell over. Like, she was just like, what? So surprised. But that's so much fun. I love doing stuff like that. Just crazy surprises if I can.
That's good. It's good. I surprised my grandma last year, and it was the last time I ever do this because it was just too much as as an emotion.
Oh man. Oh, it's so much fun though, isn't it? It's not gonna get them a heart attack or anything.
Yeah, exactly. Cool. We have almost 100 people, so we can get started while others join.
All right.
But really excited to have you again, Andrew. I'm just gonna do a quick intro and we'll get right in. We have a big topic to cover and a lot of portfolios in the negative to reassure. So we'll leave a lot of time for Q&A as well. But to give you context on today's objective, we really hope that you leave this session more comfortable with the current market environment and with better behavior and more guidance to really look at things whether it's news, whether it's a commentary around dinner or anything, to put it in perspective into what you should be really doing with your money. My name is Chahwan. I'm the co-founder and CEO of Sarwa. We're the MENA region's largest investment platform, where we help people invest into ETFs, index funds, stocks, to build a better future. But in parallel to that mission, we want to really educate people on investing and the best behavior. So today, we won't be promoting Sarwa in any way. Of course, if you have a question on how we do things, we'll answer it. I will answer it. But the main man of the show is Andrew today, who's written a lot of amazing books that you can find very easily on Amazon. And more recently, the book Balance, that we've been pushing and promoting, as it's an awesome book that's not just about investing, but about tying it with the rest of your life. So with that, Andrew, do you want to say a few words before we kick it off?
Oh, I'm just actually really looking forward to talking about this, because much of what we're going to talk about today is really counterintuitive, but it's so important for the mindset required to actually build wealth and then financial independence.
Awesome, great. So just a quick disclaimer before we kick in. We're two things. The first one is that we're not going to be giving one-on-one financial advice. The reason why is because we are regulated, so we can only give advice to our customers that we get to know well. But don't worry, we're not going to shy away from giving you as much information as possible for you to benefit from this. The second one is that this session is not meant to be a prediction of what's going to happen, like some of the people that pretend that they can do that. On the contrary, we're going to look at a lot of facts, a lot of studies, so that we can be informed based on the past, but not in any way are we going to let you know that this is exactly what's going to happen. And in fact, we don't believe that anyone can really predict it. So with that, the main purpose behind this session today is what's happening. We're seeing a lot of investors look at their portfolio and see a negative return. And we want to really flip the switch, because one of the biggest enemy, I would say, to your own investment journey is your emotions getting in the way. So if we can get your emotions managed, then we're going to make sure that the returns you see from some of the charts and the data, such as a 7% and 8% return a year, you can actually get that return over the long term and not get in the way of your own success. Because what we found is that the voice in your head that's telling you to sell, that it's time to get out before it goes down further, and all of these thoughts that make you want to act, we're going to show you today that it's not in your best interest. And we've seen the mind do two things. When things are really hot, we start to have this buy attitude where we're not as disciplined, and we start to buy things that we shouldn't really be buying or not based on value. And we see the opposite effect when things are down, where we have this panic moment and we might want to sell. So we're going to look at today we're going to dive deeper into two studies, and then open it up for the majority in Q&A for you to answer anything. So just a bit of housekeeping. If you want to leave questions in throughout the session, that way we'll prioritize them based on that and try to answer as many questions as we can. All right. So with that, to frame also the context on why we want to look at this today, is the performance up until now hasn't been that great. And it's really across the board, where you have diversified portfolios down about 20%. ARK Innovation is down about 60%. That symbolizes tech stocks. Bitcoin is down about 60%. And the tech stocks specifically, so Facebook, Apple, Netflix, etc., they're down about 40%. So unlike certain years where you see diversification in one or the one asset class being up and the other one being down, we've seen that across the board, and even bonds being hit. But you can still see that you would have had much less of an impact in a diversified portfolio. So 100K would be about 80K for the diversified portfolio, but versus for the rest, you would be living a very different reality. So before I continue, Andrew, did you want to comment maybe on I think this is from one of your great blog posts, if you want to comment a bit around what you wanted to highlight from comparing an index portfolio to some of the Cathy Wood that you like to comment on every now and then before we move on.
Yeah, thanks. I mean, that's a pretty good point where, if you have a globally diversified portfolio, on aggregate over time, businesses increase their earnings. So, 10 years from now, 20 years from now, 30 years from now, the world's businesses will be earning more money. And I'm referring to that in terms of businesses, the businesses earning money. So it's different to the stock market, something separate. But over lengthy periods of time, that reflects in stock market growth over time because they're correlated. So as businesses earn money, generally the stock market will follow that. It's not on a year-to-year basis, but because sometimes stock market rise faster than corporate business earnings, sometimes the stock market will even drop a little while corporate earnings have risen. But over time, they're like a dog and a leash. You're not going to get separated from your dog. Your dog might run up ahead or run behind a little bit, but if you're the corporate earnings and you're marching forward, your dog must march forward too, basically at the same kind of pace as you. And when markets drop, we know that on aggregate, businesses earn more money. The risk here is when you're buying individual shares. If you're buying individual shares, there can always be individual shares that end up going bankrupt. So this can happen. So you put your faith in 5 or 6 or 10 different stocks, thinking everything is going to be great. And if a couple of them end up struggling, they may not recover. Whereas if you have a globally diversified portfolio on aggregate, that portfolio will always recover. But if you're handpicking stocks and you're thinking, well, I'm getting a better deal now because markets are lower, that is true. We're always getting a better deal when the markets are lower. But a lot of those stocks, or some of those stocks, might never recover. And so this is a point that's so important when we look at what ends up eventually moving the market. And it's generally unpredictable stocks, not the stocks that you'll predict or you'll think will make money. So handpicking stocks is really tough. And then chasing, your handpicked stocks with fresh money when the market drops is far more of a risk than when you have a globally diversified portfolio and the market's down. This is actually a wonderful thing because on aggregate, you're buying businesses at lower rates and you're buying the entire market, and the entire market always ends up recovering.
Yeah, that's a really important distinction, because even as advisors, we have a lot of confidence saying things will rebound, but this is when we're talking about a diversified portfolio. As soon as someone starts to name drop a few certain stocks, we're much more cautious into making a claim like this, because it's unprecedented. You really don't know. This is where you're carrying that company's risk as opposed to an economic risk of hundreds, if not thousands, of companies. So the question we're going to get into in this section is, should you worry about this? Should you worry about these drops? Or on the contrary, similar to what Andrew was saying, can we see this as a discount? And we often find that with all aspects of our lives, we usually celebrate a discount on merchandise, especially now that Christmas is coming up. We would celebrate a 20% discount on something we wanted to buy anyway as a gift. But why is it that when it's our portfolio, in theory, it makes sense, but it's still nerve-wracking to look at your portfolio and sometimes see 6 digits in terms of losses, especially as you get closer to retirement. So we don't underestimate the impact of something like this. But let's quantify it a bit more. So Andrew, you did this really cool comparison between 2 scenarios, and would love if you can get into it and then interpret the study that you wrote about into comparing the 1995 to the 2020 year or so period.
Yeah, thanks, Mark. It's interesting because what's intuitive isn't necessarily what's good for us. And so, especially if you're fairly new to investing, and you've only been doing it for a handful of years, especially then, a stock market drop early on is a fantastic benefit to you. Even for me, I've been investing for years, but I still earn an income. And so for me, I actually much prefer to see the markets drop versus the markets rise. Because as someone with an income, I'm continuing to add money to my investment portfolio. When markets drop, I'm able to get a better deal on the same amount of money that I may have been investing last year. So I'm buying more units. And we know that the stock market rises over time. That always happens. When the market pulls back, this is actually a wonderful opportunity. And so what we need to do is we need to rewire our thinking. We can't necessarily listen to the news media that says, the headlines will say, investors lose as Dow Jones hits lowest point this year. No. Investors don't lose when the stock market drops. Investors win when the stock market drops, because investors were implying someone adding money to the markets. So I've been investing for 33 years. I am still earning an income. I'm still relatively young, even though I look old and bald. But no, I'm still relatively young. And so for me, market drops, I much prefer to market rises, because the market rises are inevitable. They're going to come. But wow, when I have my income and I'm able to continue adding money at lower and lower prices, it's so beneficial. So Mark's brought up this example here, and I wrote about this example in a couple of books. One that Mark mentioned, which was Balance, and then the second was in Millionaire Expat. So I wrote the 3rd edition of this in 2022. Shameless plug for the book, but this was in chapter 5 of this book, so one with the sort of blue cover. But let's go through this. Let's have a look at this. Okay, so if I asked you, I said, actually, I'll stay right there, Mark. If I asked you, okay, so which scenario would you prefer? Would you prefer to see stocks average 9.33% for the next 20 years per year, and to see stocks soar for the first 3 years of that time period? Or would you prefer to see stocks average 6.5% per year for the next 20 years, and for stocks to drop 3 years in a row for the first 3 years? Well, if I ask you that question, most people will look at that and they'll say, well, this is obvious. What Mark called the warm start here looks obvious. Well, of course, I would prefer that the stock market earns 9.33% over the next 20 years instead of 6.5. Of course, I'm not silly. Plus, I would prefer, on the left there, the warm start, where the first 3 years are great returns. Absolutely, I want that. I wouldn't want that situation where stocks drop 3 years in a row, which is what you see on the right. But let me show you why Warren Buffett says that investors, this is people who are adding money to the markets, should much prefer to see the market drop instead of rise while they're adding money, especially, as William Bernstein says, especially when they're just starting out. So Mark will show the next slide. So we have the two examples here. So you have that scenario one, where the market's added 9.33%. And in this example, somebody had started with an initial $10,000, and then they added $1,000 a month. If you look, the market's earned 9.33%, and the investor's money-weighted return was 7.62%. So it was actually less than the value of the overall growth of the market in that time period. So this is through dollar cost averaging. Sometimes that happens. Scenario two, you can see that the markets would have made 6.5% over this 20-year period, but look at the money-weighted return for the investor. Now, this was the scenario where the investor started out and the markets dropped, boom, 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 3 years in a row early on in the investment journey. The money-weighted return is higher. Now, money-weighted return is actually your return. So how can the market earn 6.5% over a 20-year period, but you, the investor, earn almost 10? So this is a result of that. When that market drops, this dollar cost averaging allowed you to buy more units at a lower price. When those units ended up recovering, it ended up boosting your personal money-weighted return. If you added money to the markets this month, you got a better deal than that same amount of money added this time last year and this time the year before. When that money recovers, and it will, that's when you're going to see really nice growth. And here's the thing that's very counterintuitive. Many of you will say, well, I'm really hoping the markets recover this month. It's just driving me crazy. It's pulling my hair out. Here's a scenario for most of you who are listening to this. It would be better if the markets do not recover next month. Mm-hmm. It would be better if the markets were actually a little lower next year than they are today. It would be even better, an absolute gift, if the year after that, the markets were even lower. Because you are collectors of market assets. You are buying businesses when you're investing in a global portfolio. And if the prices of those businesses are low, remember, it's like that dog in the leash. Corporate earnings are still rising over time. And over time, eventually, when that market recovers, your portfolio is going to soar. So you can see in the example that Mark created with this chart, that blue line is the cold start. And you can see there's a dramatic difference over 20 years. So if you are new to investing, especially you've only been doing it for, I'd say, less than 10 years, even for somebody like me, it's an absolute dream right now to see the markets dropping. And the lower they stay down, the better. It's like an elastic, though. It won't stay down forever. It will eventually end up rising.
Love it. Love it. Thank you, Andrew, for that. To just drive the point further, we looked at someone, and just to recap, we looked at someone. So as long as you're basically earning in your early investing life, which is even more prolonged than your career, because sometimes people anchor to that 65 mark, but your investment portfolio is to cover all of your life expectancy. So as long as you are earning and accumulating units, this is why we would celebrate ultimately, and it's better for you to buy when things are lower. However, let's also look at a scenario for someone that is going to be retiring, because it's not just, when we think of investing, ultimately, what is the ultimate goal? It's to live out of and have that as a stable source of income that's predictable and that you can live out of. So we're not just going to look at for people that are accumulating wealth during their younger years. We also want to understand the impact of volatility for people that are maybe close to retiring or want to imagine once they do retire, what does that look like? So, but before that, let's maybe answer the question, is this market downturn different? And that's usually sometimes what messes people up from from looking at data is they feel like this one is maybe different, especially with the news that uses words like unprecedented and many other things that make you feel like
the stuff they say every time, because it's
Yeah.
always different. It's always different. That's what makes it all the same. It's always different.
Yeah, exactly. So would love it, Andrew, if you can maybe comment on, you have more than 30 years of experience. So how does that compare? If you can just expand a bit more on how they're different, but also if we can get into the 4% rule as well. And I'm going to charge my laptop in the meantime, so I'll be right back.
You charge your laptop, Mark. I guess, and even to back up too, just so that nobody misinterpreted what Mark and I were saying about adding money to the markets, and it's better when the markets are lower. One thing some people might do is they say, well, okay, well, I'm not going to add money then. I'm just going to wait until it drops. That's market timing. That's trying to speculate. And none of us can do that. I can't do that. You can't do that. Warren Buffett can't do that. No one can do that. And so there's reams of evidence supporting that. So add money whenever you have it. So if you have money now, you've just sold a house and you've got a bunch of money and you want to invest it in the markets in a diversified portfolio, do it now. If you're adding, or if you got regular sums or regular income and you have an amount that you invest every single month, just invest it. Don't try to time the market, because you'll end up over time, if you end up going into that casino, and I call it that casino, like when you're trying to market time, eventually the casino wins. So that's the thing. One of the worst things you can do too is actually get lucky with market timing. Because if you get lucky once, it's like some joker walking into the casino and actually winning first day in. Okay, they're hooked for life on that. They think that they can make money in the casino. So invest as soon as you have the money. Don't try to time the markets, and welcome market downturns. Back to Mark's question, is this market downturn different? Every market downturn is different. And it's great. It makes great headlines for people to say, well, this time it's different. There's always something that is happening that has never happened before, every single time. So that's why, like, for me, a geek like me loves to read market research and old investment books, like some really, really old classic stuff, like 1932 edition of Security Analysis. I know you got to be a total geek to read stuff like that, but I can tell you, every market downturn is different. Every single time, something unprecedented that has never happened before in the history of markets ends up happening every single time. And it's funny to see the headlines, oh, but this time it's different. They said that in every downturn we've ever had, in 1974, and they said that in 1982, when the markets had gone about 17 years where the Dow point level hadn't increased. And they said that in the year 2000. They said that in 2008. I mean, this time is different. The entire world was coming to an end. They said that in 2020 with COVID. We've never had a pandemic before. This time it's different. 2008, we've never had big companies like Lehman Brothers go bankrupt. The biggest banks in the world are going bankrupt. The whole world, this is financial Armageddon. It's always different. And that's what makes it always the same.
Yeah. I remember, like, especially with the lockdown and everything, it's easy to want to believe it, but you're right. I saw a lot of charts also that show the impact of, sorry, we'll get to that in a bit, of all the other pandemics and how long it took for the market to recover then. So I get you, but I guess, how does this tie to, I like 1973, and we're going to pick on that year because, first of all, it's far enough that it can represent a different time, but it also is similar in some way where you have a lot of inflation. So it can be compared to some extent to what we're doing now, because I found that some people, an argument they will use is, yeah, but comparing the 2008 crash is different. We didn't have inflation like we had today. So we're going to look at that a bit. But before we look at 1973, maybe, Andrew, if we want to summarize the 4% rule, I'm happy to do that. But if you want to take a first pass as well.
Yeah, sure. So the 4% rule has been back tested to 1926. And this is what it means. It's essentially for a retiree. So if you think about a retiree, they have a portfolio, and let's just say it's $100,000. That's easy for me to do just mathematically. On the first year of the retirement, they withdraw the idea is based on the 4% inflation adjusted rule, they withdraw 4% of that portfolio. So they withdraw $4,000 during year 1 of their retirement. Now that's their base. In year 2 of the retirement, they withdraw a little bit more than 4,000 just to cover the rise in the cost of living, so inflation. In year 3, they withdraw a little bit more than that. Again, each year withdrawing an amount and increasing it in line with inflation. And the idea behind the 4% rule, and as I mentioned, it's been back tested to 1926. And so essentially what that means is, historically speaking, if you have, let's say, a portfolio of 60% US stocks and 40% bonds, and you do the inflation adjusted 4%, your money would have lasted at least a 30-year duration. So you could have retired feasibly in 1929. Markets that year dropped 87% between 1929 and 1932. It's kind of like a 3-year boom, 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 boom. You would have lost 87%. And I say lost, wouldn't really have lost unless you sold everything. But if you were withdrawing an inflation adjusted 4%, your money would have lasted at least a 30-year duration. So I like to actually too refer to the 4% more as a guideline than a rule. And I guess probably for reasons that we'll talk about here going forward, because the 4% rule has a couple of risks. The biggest risk, and you're not going to read this in the literature that you might see online, the biggest risk with the 4% rule is actually dying with too much money. The second biggest risk is running out of money. But the bigger risk is actually with the 4% rule is actually dying with too much money. That's actually the bigger statistical risk. People don't talk about that. They talk, well, there's a tiny possibility that, there's a possibility that you could run out of money before a 30-year duration. And we will talk about that and refer to why I like to think of it as more of a guideline than a rule.
Yeah, I love that, because you're right. If you die with too much money, then you could have retired earlier. You could have had a different lifestyle for you, for your family. So it's equally important to get that right.
Actually, Mark, should we talk about 1973, I think, when we talk about that specifically? We could talk about that. Yeah. I mean, talking about an unprecedented time. And I'll tell you this, that if you talk to somebody that actually truly remembers 1973, like they really do remember it. And it's funny because when people talk about like the good old days, generally the good old days are for people that have bad memories. Right? I mean, every time has its issues. So 1973, the world was pretty darn unsettled. We were far, far closer to nuclear war than we'd probably been almost at any time in history. The Cold War was at its peak. We were running out of oil. In the United States, there were times when people had to wait in lineup at a fuel station for 2 days to get fuel. This is the United States of America. So there was a massive global fuel shortage, and inflation was running rampant. So we were looking at, for much of the 1970s, double-digit inflation. In 1974 alone, inflation was 12.7%. We're not just talking about inflation too for like a 6-month period or a 12-month period. It ran high for a decade. And those of you listening to me here and now might recall, if you talk to your parents, how expensive mortgages were if you wanted to actually borrow money to buy a house. So mortgage interest rates ended up peaking at close to 20%. So my father's friend ended up renewing one of his mortgages at 18.5% in Canada. So, when we talk about unprecedented times, 1973 was a horror show, an absolute horror show. The markets, if you want to talk about that, dropped about 50%. So if you had a globally diversified portfolio of stocks and bonds between 1973 and 1974, it got absolutely kicked to the curb. I mean, far more so than our recent market drop. However, if somebody had retired in 1973, despite all that, and if they just rigidly stuck to the 4% inflation adjusted withdrawal rate, and remember, if they're adjusting for inflation, and inflation is like 10, 12% per year, and the markets in the first couple of years got absolutely kicked to the ground, you'd think that person would have run out of money. The irony is, this was about 50 years ago. So we're looking at 49 years now. That person who retired in 1973, which would have been like one of the worst times in history, definitely worse than what we're looking at right now, would still have money left today after 49 years of inflation adjusted withdrawals. And that's fascinating. They'd have actually a little bit more. If they started with $100,000, they'd have about $160,000 today. It's kind of inevitable that eventually that would run out of money. So it looks like it might run out of money like on about the 60th year. But this is why I've sort of come back to that point where the bigger risk with the 4% rule is actually dying with too much money. But the scarier risk, that's never scary for people. The scary risk is actually running out of money. And that's why we can talk about the flexibility of the 4% rule.
Right, right. I just want us to look at some of the numbers you mentioned because they're crazy. When you look at how much what you can do with $1 million when you retire and live off of it. So we looked at 1 million instead of 100,000 just to make it maybe more real as a number that a lot of people anchor on. And to drive that point across, in 1973, if someone retired with $1 million and used the 4% as a guide, so here in the first year, that's $40,000 that they would live off of. And the next year, they would adjust it by 8.7% and withdraw $43,000 and 480. What we can see from the data from someone investing in a diversified portfolio, 30 years later, that person would still have a $2.3 million portfolio and would have withdrawn $3.3 million. So imagine that you withdrew more than the initial investment and you still have money left from being able to invest. But this picture is only possible if you don't get in your way. This picture is only possible if you continue investing. If you can't even withdraw and stay in cash for a few months. Even the impact of that can be disastrous on your wealth if you try to time the market. So of course, this is an amazing picture for any long-term investor, and a time that you would never guess this is the type of outcome that you would get from the scenario that Andrew was describing while you're waiting for gas and you had such a high inflation. But that's why we keep anchoring and we do these webinars, and we want to do a lot of education, because you need to be disciplined and not freak out and continue investing for you to have outcomes like this.
I mean, the biggest challenge isn't the market, is it, Mark? It's people's personal emotions. It's funny, I just read yesterday, so I happened to be in Canada visiting my parents, and I read that Canadians have withdrawn, they've had net redemptions of $9 billion from mutual funds this year. They're selling because the markets are cheap. The markets are dropping, so they're selling. And it's really, really hard for people, especially retirees, getting that. For them, they see this is their nest egg. They're not adding to it, and they see it depleting, and it's very, very frightening for them. And so the example that Mark is showing you here is just someone who very dispassionately just followed that 4% rule from 1973 on. And it's so easier said than done. I mean, one of the best things we can do is turn off the market noise. Don't even follow the stock market. Just try to focus on, your inner Buddha, your inner Zen, and focus on more important things in life than thinking about the markets.
Exactly. So before we still have about 30 minutes for Q&A, but to recap our suggestion here, it's to stay invested. So avoid the behavior of some of the retirees that are freaking out. Invest regularly. And one way to do that is to set up auto deposits so that you can take the guesswork out of and the emotions out of investing. And finally, to zoom out. So we're lucky to live today where we have so much data behind us, so many studies that can reflect and are in some ways similar. So history doesn't repeat itself, but it definitely rhymes. So this is the point of inviting people like Andrew that are just market geeks and really look into all kinds of eras to draw lessons from. So with that, thank you, Andrew, for presenting these two data points, and we're going to start with questions, and we can tag team them together. All right. Anonymous attendee, I'm looking for an investment option for my kid who is 10 years old as of now. What option can I consider for my child?
You take that one, Mark.
Sure. Yeah. So the younger the investor in general, you're going to be able to benefit from more time in the market. So first of all, like, great job, and your child is lucky for you to be thinking of their future so early on. So the option, typically financial regulations won't allow people under the age of 18. But however, I can tell you in our case, we make it easy for you to either name the account. We see a lot of parents name the account the name of their children and have many accounts, and you can even assign a beneficiary. So these are some of the ways where you could do that. The likelihood of you being in a majority stocks portfolio is really, really high. The only thing that would go against that is if you're a new investor that is at risk of maybe selling if things get volatile like they are today. But in general, given that your child is so young, then you can afford to be in a higher risk portfolio that's mainly in US and global stocks. A question from Ali. What are your thoughts on actively managed ETFs, especially those following the sector rotation and momentum styles? I'll let you take that one, Andrew, as I know you cover also ARK maybe as an example of actively managed that maybe draws people towards ETFs, but ends up being a very different beast altogether.
Yeah, that's a really good question, Ali. And I'm not a fan of actively managed ETFs or active management of any kind for several reasons. One is that, of course, nobody can actually see the future. And when we jump onto momentum, and perhaps it's not 2020, the wonderful momentum was financial technology stocks, a lot of the stuff that Kathy Wood was buying for ARK Innovation. And generally what ends up happening is, of course, trends reverse, and you'll have a sector that's flying and most people will jump on board. And a lot of ETFs will get actively managed ETFs will get created as a result to take advantage of that trend, or an existing ETF will want to take advantage of that trend. They pile money in, and then there's a reversal of fortune. And nobody knows when that reversal of fortune is. And so such a good question, Ali, because it's, intuitively you think, well, this has got to be good because you've got these analysts who are trying to predict where things are headed. They're jumping on where we're seeing momentum. But unfortunately, that momentum shifts faster than these people can actually make adjustments to the portfolios. And so on aggregate, that's why we see active management underperforming on aggregate a portfolio of ETFs. So Kathy Wood's ARK funds was a wonderful example of that. So everybody ended up bandwagging on the innovative technologies. And it was a strange thing because, of course, a lot of those companies that she was buying, just about all of them, they didn't make any money. They didn't make profits. And yet people bandwagoned onto them. So I would suggest not to follow any kinds of trends, not to follow anyone who suggests that they can put money on the markets based on secular movements, any kind of forecasting at all, and just stick to a diversified portfolio of ETFs.
Love it. Completely agree. And a question from Medhat: for beginners, do you think that it is the appropriate time to start with the stock market, or to wait for the global chaos to settle down or reach the bottom is a wise decision?
Yeah, great question, Medhat. Nobody really knows, though, where the bottom is ever going to be. And so for that reason, that's something that we would refer to as market timing, trying to figure out where the bottom is. Because when you're living through it, it's easy to see where the bottom was when you look back at a past chart. You can see, oh, there was the bottom. There was a bottom. There was a bottom there in March of 2003, and there was another bottom there in March of 2008. But when you're actually living it, like I was living it in March 2008, actually it was March 2009 that the bottom hit. We didn't know it was the bottom. We didn't know. And so when you wait for things to settle down, also, the idea of things settling down is to use Benjamin Graham's voice here, his quote. He was Warren Buffett's instructor at Columbia University. He was one of the greatest investors of all time. He says, you pay a high price for a rosy consensus. Things settle down. There's a rosy consensus. But when things have settled down, by then, prices have already risen a lot. And so unfortunately, you've missed out. So when you have the money is when you should be investing, and as soon as you have the money. Ignore the markets, ignore economic news, ignore what's happening politically in the world, ignore the wars, and just add as soon as you have the money. If you continue to do that over time, you will pay a lower than average price. And if you're just starting now with the markets at a discount now, that's awesome. And if the markets continue to drop while you're adding money, don't lose faith in that. Just continue to add money and try your best to think about other things instead of the market itself. Because the more we think about the market, the more tempted we become to try to speculate, the more fearful we can be when we actually see our money drop.
Yeah. There's a lot of studies also that show you the impact of staying cash, even if it's for a day or a month. So it's easy to say I'll enter when things settle, but usually things don't fully settle because there's always going to be like some factor. And also by that time, as Andrew said, things you would have missed the boat. And we've seen that in 2020. I remember we did a webinar together and we saw a 10%. Sometimes you see a double-digit increase in a day. So imagine missing out on that one day that it ends up impacting your return if you do that year over year. A question from Savio: in terms of asset allocation, would it be favorable to increase exposure now from a 5-year investment perspective to certain defensive sectors such as healthcare or consumer staples or big tech sectors, considering the massive decline in tech stock valuations?
That's another good question. First of all, the terms that we need to think about, which Mark talked about earlier, is our lifetime instead of thinking in terms of 5-year terms, because you're going to be investing your lifetime. Your money will be lasting hopefully as long as you last. So your investment duration is longer than 5 years. So for me, for example, I'm 52. If I live to 92, my investment duration is 40 years. And this is how I have to be thinking about it. If we try, and it's really intuitive for us to try to move our portfolio into something defensive when markets drop. So to try to mitigate somehow that actual loss. But unfortunately, when the market rebounds, you're still in something defensive. And as Mark suggested, a market move can occur in a single day. It could be a single gain of 10% in a single day. So my suggestion is, this is a lot like trying to tactically allocate money, and the research on tactical allocation funds. So this is literally people who are trying to, and they're professional analysts, who are saying, when the markets drop, I'm going to try and move into something defensive. And then before the markets rise again, I'm going to try and move into something a bit more aggressive. They end up over time dramatically underperforming a global portfolio of index funds. And it seems like, it's hard to imagine that this is actually the case, but reams of peer-reviewed academic evidence suggests the same thing. So I know it sounds really boring to stick to a portfolio of ETFs and just keep adding money whenever you have it. But if you're greedy, like if you're truly greedy and you want to maximize the amount of money that you're making over your lifetime, that's what you do.
Yeah, exactly. That's the counterintuitive thing, is we're so used to doing something about the situation, where in this case, it's better not to do anything. And a lot of the active wealth managers will publish. I saw UBS actually published a white paper today around how they're doing to manage this, but it's mainly to be able to justify fees to some clients that are paying a premium to the bank. So a lot of that is also to justify fees and it's super like, ultimately, imagine what are you gonna do if all your job is to buy and hold and recommend investing more. So it's that simple sometimes, but also counterintuitive. A question from Salim on what we recommend to balance between investing versus expenses. I'll answer that one quickly, but the answer is depends on your, of course, on your situation. We often mention the 50-30-20 rule, where 50% for your needs, 30% for your wants, and 20% to once you've built out your nest egg and your emergency fund, then you use that to invest as much as possible. But we've seen also the FIRE movement. For those of you that are on Simplify as well, I know we try to push ourselves to invest more than 20%. I've seen people and some clients go up to 70% of their income, because then they can retire in about a decade of working as opposed to multiple decades. So that's, we've seen it across the board. It's very inspiring when we see these really high numbers of people that are able to live frugally. But, and I know you wrote that about imbalance, Andrew, where, however, don't push it where you're maybe compromising on your current life just for the sake of retiring. So it's up to you, Salim, but I think starting with a 20-30% could be an initial challenge for you. All right, a question from Anonymous is, I've invested $2,000 with Sarwa in the highest risk profile, currently at a $400 loss. What happens if I reduce my risk profile to a 4/6, so a more balanced portfolio? First of all, as you saw from today, this is completely normal with what's happening today, as our portfolios map perfectly to a globally diversified portfolio. If you were to reduce your risk profile, then you would go and sell stocks and have more bonds. So effectively, yes, you would be realizing more losses as stocks went down more than bonds. So this option, we only leave it as a last resort when a client is really, they want to reduce the heat and they feel like they can't handle it. From the way you're writing the question, I don't think that this sounds like you fit that bucket, and you being here today hopefully gave you more knowledge to be able to stay the course and stick to your profile. So this is more of a last resort when certain clients say, I want to go all in cash. We present that option to say, well, you know what, instead of going all in cash, maybe we can turn down the heat. So definitely not the first recourse of action, but an option you have that in case you're really uncomfortable with the volatility and you feel like you're about to make a mistake if things stay that way.
Yeah, that's a good point, Mark. On the flip side too, if you go more defensive when markets drop, you will make less money when markets recover too. So I think that overall education is really important. But like Mark said, if no matter what I say about, no, this is actually a really good thing, if it's just freaking you out, then as Mark suggests, going slightly more defensive when markets drop, but do realize that it will cost you money. That will cost you money. You will end up with less money. Guarantee 15, 20 years from now. But if you're that sort that's just going to capitulate and you're going to freak out, and freaking out would mean you have even less money because you want to pull everything out, then absolutely, go with that defensive notion. But just understand the big pro and the con on that one.
Awesome. A question from Jandre. So a lump sum, do it immediately?
Research suggests yes. So research suggests that most of the time, it's about 70% of the time when we look at rolling 10-year historical periods, it's better to invest that money upfront versus dollar cost averaging. So if you have the money, the idea is if you want to maximize the probability of the most money over your lifetime, invest as soon as you have it. So if you have a lump sum now, invest it. If you don't have a lump sum, but you're earning regular income, invest money as soon as you have that money. That's no guarantee. Of course, you could invest a lump sum and the markets could drop, 50% over the next year or so, and you could feel totally gutted by that. So I'm just talking about probabilities here. So probability suggests that the earlier you invest it, the higher the probability of a larger return over time. But if you're the sort of person that would really freak out if you saw the markets drop another 10% tomorrow after you put in a big lump sum today, then you could perhaps space that out. You could split it up and decide over the next year, maybe you're just going to split it into quarters and put that money in quarterly. For me personally, I don't mind seeing market drops. It doesn't affect me because I know that market prices are always temporary. So I'm not really bothered if I put in a big lump sum today and the market's dropped tomorrow. It wouldn't really affect me. Call me a freak if you want, but it generally wouldn't affect me. But if it would affect you to the point where you might freak out and pull everything out, then don't invest the lump sum. Just break it up into chunks over a 1 year period, say 4 chunks over a 1 year period.
Awesome. Thank you, Andrew. Question anonymously: what is the minimum monthly amount I need to regularly invest, assuming $5,000 starting, to have a meaningful return in the long run? So the question is, it really depends on your expenses, but the return is a percentage. So the more money you put in, the more money you'll get out of your account. But to be able to answer how much do you really need, this is where I recommend that you check out, we have a retirement calculator. Vanguard has a great one as well, where you can see, if I want to live on this amount of income, how much do I need to be retired with, and how much do I need to be contributing every month? And most of the time, just a heads up, it's not a pleasant surprise, because you realize you need to be investing quite a bit if you want to retire at that age. But it's a fun exercise where you can visualize and feel like you're more in control of your spending and your saving, so that you decide what kind of lifestyle you have, and if you want that lifestyle, what kind of monthly contribution you need to be making. A question for you, Andrew, from Wally. I'm following Andrew's teachings from the Balance book. Something that has challenged my thinking about wealth is a book by Bill Perkins, Die with Zero. It argues that as our earning power increases with age, it's not necessary to save too much early on. And also, as our spending falls with old age, we end up with excess savings and less living experiences. Can you comment on this point of view?
Well, I mean, I haven't actually read the book, so to be fair, I'm not really sure, but I tell you what I do know. I do know that just from personal experience, having invested money early on has given me a lot of freedom of choice. And so, I'm sitting here in front of you in Canada. I've never had a massive income. I know a lot of people in the UAE have got really big incomes, and they're able to put away 70% of their salaries. That never would have been possible for me. However, just based on the amount of money that I made over my lifetime as a teacher. But having started early was just such a blessing. I mean, it was an absolute gift for me, because I was able to save far less than people who started later than me, by using the power of compound interest, by using time and putting time on my side. So I invest less. So here's probably the main point here. I have saved less money than most of my friends because I started early. And I have more money than most of my friends because I saved early. So in essence, I've been spending more. I can spend more than my friends, not just because of my investment portfolio size, but over my lifetime. If I save less than somebody else and we earn the same amount of income, if I save less, it means that I get to spend more of my income over time on average. And that's what I've actually been able to do. So there's a balance there. And I think one of the most powerful things is really you putting time on your side and getting that money started early. And then you get it started early, you have to save less than most people do, you save less than everybody else who ends up having to start or investing later.
Thank you, Andrew. Question from Oleg. As long as we're talking about the stock market, there is always a chance to lose everything. How will Sarwa manage that? I think here what I'd like to say is what you're describing is closer to trading than investing in a diversified portfolio. And it's we touched upon that earlier, but the type of swings where you see these losses around, as you're saying, losing everything, 80-90% drops, that's extremely rare to see these drops. And we had to go until 1929 to see something like that in the stock market in a diversified portfolio. However, another point here is that you don't lose until you sell, or unless you sell in a diversified portfolio. So the way we manage that is exactly what we're doing here, which is helping you avoid selling. And the thing, when we moved to the UAE, we realized one of the most common things was the saving plans, where people are locked in and cannot withdraw. And as much as we hate these products and we often write about and talk about how they're terrible, they do have one feature that's good for you, which is you can't, it's a very high cost where you can't really withdraw your money immediately. So it kind of blocks you from doing that. And it's funny because for us, we decided not to have any lock-in, or it's your money, you can withdraw at any point in time. But there is actually one good thing about them, which is it protects you from this rash behavior, because it's, as we said, it's very frightening. As Pranav, you pointed out in the questions as well, it's very frightening to see that 20% drop. So the way we manage that is through helping you avoid these mistakes, but also, of course, diversifying across thousands of companies, geographies, industries, so that we can get better predicting behavior around how a diversified portfolio has behaved in the past and how it will continue to behave. But Andrew, I'm not sure if you wanted to add anything around these scenarios.
No, I think that sounds really just good. In that the idea that, I think that back to that, probably the initial fear is that the money will drop, right? And the money will be gone. And if businesses on aggregate continue to earn more money because you're fully diversified, you're owning all of the world's businesses, and those businesses will continue to make more money over time. So the market can't go to zero. An individual share can, individual stocks can, they can go bankrupt. So we have we have histories of lots of blue chip stocks too, that have they were darlings. Everybody loved them. If you look at the Dow Jones Industrials and look at, well, what were the Dow Jones Industrials in 1940? Well, you won't recognize them today. Like, they're not the same stocks. A lot of those stocks are just, they're done. They're over. They're bankrupt. And they were super popular in their day. So, but the idea is, if you own the entire market, the idea of the money going to zero is, the probability of that is zero. In fact, okay, if it did happen, it would be one of those things where before that happened, the world would blow up and it'd be in a big fire and there would be no stock market. It's probably the way to do it, but we wouldn't be living anyway. It would just be like the end of the earth. So last thing we'd be worried about is our stock market. I shouldn't be laughing at that, but yeah, it's basically the only way that you'd actually end up getting a diversified portfolio going to zero.
Yeah, which then is a new world. So anyway,
or a no world
from
yeah.
A question from Zaid Shalhoub. Do you think it's wise to take advantage of the downturn by increasing your monthly investment this year and the next, for instance? Or is it smart to maintain the same amount of monthly investment made into your account?
That's kind of a neat question, because in a way that's the opposite of what is often asked. Like, how can I don't want to put money in because markets have dropped. I'll tell you why I didn't typically, for me, the answer to that question, I think the short answer to that question is probably yes. However, I think more practically, from a practical perspective, it's that I think when we do our financial plan and we determine how much we can invest on a monthly basis to allow us to have enough money to be comfortable with on the other aspects of life, and we maintain that. For me personally, I was kind of really, really keen to become financially independent early on. And so I invested as much as I could on a monthly basis, allowing me to have the lifestyle that I still wanted to be able to lead. And so when the markets had dropped, I didn't really have any more extra money to be putting into the markets because I was already investing as much as I could on a monthly basis. So if you want to be aggressive about your financial independence and gaining financial independence earlier, that would be a better notion, I think. Is just that, invest, have a plan. This is how much I'm going to be investing per month. If you're very tentative and for whatever reason, I don't know why you would invest less than you can at all anyway. I guess that's a mystery for me. Like, why would you invest less than you can? Because the more you invest over time, the greater your probability of future financial independence would be. I think that would be my answer.
Yeah, agreed, Andrew. I'm just conscious it's 7, so we'll pick 2 more and we'll answer the rest by email. Sorry, we didn't. Every time we extend the amount of Q&A, but we get a lot of engagement. So
that's good. I love that.
Yeah, exactly.
Thank you.
A question for Doha. What is the difference between investing and trading on Sarwa, and how does that tie with Andrew's viewpoints at all? Just a quick one here. The difference is that investing is a managed portfolio by Sarwa, and what we call Sarwa trade it's not necessarily trading per se. It's more you taking control of your own investing. So it's more for DIY, do it yourself investors. So it's not necessarily, you can use Sarwa trade and be a long-term investor as well, or you can use it to trade. But in general, our viewpoint is that the majority of people are better suited with diversified investment portfolio. So a lot of Andrew's viewpoint will apply to a diversified portfolio of ETFs as opposed to stock picking.
Yeah.
Sorry, by the way, I took the liberty.
No, that was good. It was good. It was good.
But,
and what some people do too, I know this, and some people will like, they just have this itch, like they love to buy some of their own stuff and to trade, or just buy some of their own stuff and hold it. And so what some people will do, and if that's something that you want to do, is put aside 10% of your portfolio to do that. So that would be a separate thing too. And don't think of that necessarily as, you know, your future retirement portfolio. If you want to have a little bit of fun, no more than 10%. That would be my recommendation.
Awesome. I have a last one to end with that's really good, and you're probably the best person suited for this, Andrew. So from Pratap, hi, this is Pratap, a Sarwa user. Can Andrew talk about the home country bias? I am Indian and I would love to invest in a diversified index funds in India and not miss the growth story of India, which based on statistics can surpass many developed economies soon. Really like that, because I know you've also broken down investing for expats within their home country. So really curious to see your viewpoint on that one.
Yeah, that's such a good question, because you have, with emerging markets, we tend to think because their GDP growth is higher, we're looking at potentially higher growth for those industries, therefore higher stock market growth. And it is pretty interesting when we look back to 1985. So 1985 is about the earliest date at which we have emerging market data. And if we look at the fastest growing economies since 1985, they weren't actually the fastest growing stock markets. And so that's something that, you know, we have to keep in mind. Say China, for example, Chinese GDP ran circles around the United States. If we went back in time, if I said to you, yeah, we'll take you back into a time machine 30 years and give you the option of spreading out $100,000 into whatever, a variety of Chinese stocks or a Chinese stock market index, or into the much slower growing US stock market index, and you were to wait over that 30-year period, you know, most people would, if I said, send you back in time, you can go China or the United States, most people would say, well, China for sure. Like, when you look at how quickly China has grown, much like India, right? And so, and the growth prospects of China are still extraordinary going forward. They're far higher than they are in the United States, for example. India is much the same. However, the stock market in the United States has run circles around around Germany, China during that during that time period. So it's not always an accurate reflection trying to look at, well, what is economically growing, and figuring out, well, perhaps because it's economically growing, we're going to earn higher stock market returns. So William Bernstein was the first one who sort of got me out of this. He wrote a book called The Investor's Manifesto. And he was the first one that got me to looking into the research on emerging markets. And David Swenson did much the same. Emerging markets can end up with incredible returns over an annual basis, or even a 10-year basis. But generally speaking, nobody really knows. But here's my general advice here. If you're from an emerging market country, regardless of how quickly the economics of that country are growing, so say India, my advice is not to overweight that market. So just to build a globally diversified portfolio and have an allocation to that Indian market such that you would typically have within its emerging market sector, and not to overweight it. Because what we do end up getting to with such economies is we end up with some really substantial crashes as well. So in terms of the stock market, so the markets can go up and down quite a bit, but they end up crashing. So with emerging markets, that's where the rules sort of shift a little bit in terms of corporate earnings versus stock market growth, because they don't tend to be as aligned as they are with more developed market, with more of the world's developed markets. A lot of those have to do with like looser regulations and such, corporate entities that are sifting money out. David Swenson does a great job of talking about this in his book, Pioneering Portfolio Management. It's a very, very good book that he wrote for institutions like Harvard, who are investing money on behalf of those institutions. And so he wrote it for investment managers, and the data that he uses and then the descriptions and the explanations he uses for that are extraordinary. So I would just keep with a globally diversified portfolio. If you have a home country bias and you're from, let's say it's Canada or it's Australia, you do to a point reduce currency risk by having a larger allocation than would normally be needed with a normal globally diversified portfolio with a global market capitalization portfolio. So for example, someone from Australia could have, like a quarter of their equity allocation could be Australian and the rest of their allocation could be global markets. And this reduces currency risk over time. It's not a big deal though. I mean, it's really not a big deal. And they're not generally taking a massive risk by having that allocation to Australian stocks. So does it matter to have the home country bias? Not necessarily. It's really not a big deal. But if it were someone like yourself who's saying, I'm from India, should I have 50% of my stock market allocation to the Indian market because I'm from here and growth prospects are huge? I would say no, don't.
Yeah, it's the magnitude that you're pointing out to and to correct and make sure they don't double down in a really big way. I get it.
Yeah.
Awesome. Andrew, I wish we have so many questions and I feel bad to leave people hanging, but we will get back to you by email. I just like to keep Andrew on time so we can do more of these. And he doesn't hate me for dragging too long, but we'll do hopefully another one in a few weeks or in the new year to wrap up an eventful year. And
let me shamelessly promote my book. So this is this year's book for Millionaire Expat. And I'm hoping, you know what, Mark, it's the only reason I'm doing this. I've never done this before, but I've noticed in the UAE, people are still buying the second edition and it's outselling the third edition. It's like, no, this is the better book. It's the one that's up to date. But anyway, so sorry for the shameless plug.
No, please go ahead. I see it a lot, by the way, when I walk in Dubai Mall at the Japanese bookstore. If you ever pass by there, Kinokuniya, they have it, like it's very visible. So very easy.
The third edition or the second? Is it third?
I saw the second a lot, so they might be.
Yeah. So. People are sending me pictures of the second edition in bookstores in Dubai, and I'm like, no. It's like the light blue one. It's the third edition. It's the updated one. Don't buy that one. Buy the updated one. I mean, of course, I wrote them and I know it's the same fundamental premise, but I like to feel that people are getting like the updated one instead.
Yeah, of course. I get it. I'll let you know if they changed it.
They better change it. Go in there with a stick.
All right, Andrew. Thank you so much for your time and enjoy the rest of your day.
Thanks so much, Mark. I appreciate it.
Take care. Bye-bye.
Thank you. Bye-bye.